very much, Russ, and good afternoon, ladies and gentlemen. So I'll talk in two sort of sections about City of London. I'll talk about the trust itself and some of the unique characteristics of an investment trust, and then I'll move on to discuss how the portfolio is currently positioned. That first slide shows a picture of the original brewery that was the original business of City of London. Well, we were actually a brewery company originally, and the brewery lost money and was closed down in 1932, but its site on the banks of the River Thames was very valuable, and they started investing in shares. They still owned pubs until the 1960s, but obviously since then have been a full investment trust. One of the legacies is an independent board of directors, and I think that's a very important feature of an investment trust. Independent board of directors are there to look after shareholder interests. Our chairman is Sir Laurie Magnus, who's had a long career in corporate finance, City of London, advising companies. He's still an advisor with Evercore. And about 18 months ago, he was appointed Prime Minister Rishi Sunak's advisor on ministerial ethics. And from time to time, he's been very busy in that job as well. I've had the great privilege of managing the trust since 1991, and I've worked with David Smith for over 10 years in the global equity income team at Janice, Henderson, and he's the deputy fund manager. Key feature and legacy of that independent board is the very low charge, and in fact our fee was recently negotiated slightly down, and last year was a 0.37% ongoing charge, and it will be lower this financial year. And our objective is to grow long-term capital and income for our shareholders, and we are slightly ahead of Alliance Trust by a few months in our dividend record. We've got the longest record of any trust in terms of annual dividend growth, and I'll talk about how the investment trust structure does enable us to achieve that record. I work in the global equity income team at Janice Henderson. I'm actually the oldest fund manager there. I'll be 63 at the end of June, but I'm joined by James Henderson, who's 2 weeks younger than me, so I'm not completely on my own. But I've got colleagues, very talented colleagues who are kind of mid and earlier in their careers, giving different perspectives to. James and I have got the advantage of experience, having seen, been in the stock market for many years, since 1983 in my case. But other colleagues are much more closer to trends in society than I am, for sure. I work for Janice Henderson. We were actually founded 90 years ago. The original Alexander Henderson was a city tycoon of the era, and we had one client. When he died, he was our client, and we were founded to sort of manage his estate. And now we merged with Janice, an American fund management company, about 4 or 5 years ago, and we have got clients all over the world. And one of our great strengths is we have very strong analysis of the US stock market. Janice are headquartered in Denver, and we've recently won the contract for the North American Income Trust, and I think that is a tribute to the board and the manager of that trust, appointed Janice Henderson, given the strength of our research on US stocks. So let's talk a bit about the investment trust structure. One key feature of investment trust relative to open-ended is you can use revenue reserves, and the previous speaker alluded to them in his speech. But in the good years for dividends, and I'll demonstrate this in a table shortly, you can hold back a bit of the income up to 15%, and it goes in what's called a revenue reserve. And so when you're at difficult years, you can use that revenue reserve, as in 2020 when there were dividend cuts across the market. FTSE 100 dividends were down by 36%, but we were able to continue the growth of our dividend through using our revenue reserve. A second feature is you can issue shares, and you can also buy them back. In the case of City of London, we've issued a lot of shares over the last 10 years, typically at a premium around 2.5% to our net asset value, and that enhances the asset value for ongoing shareholders. But more recently, last 6 months, we've moved to a small discount around 2.5%, and we've been buying back shares, so we're dampening the discount volatility, and also that buying back at a discount is also accretive to NAV, so it benefits existing shareholders. And the third feature of investment trust, which is, again, you won't find an open-ended, is gearing. And that is kind of borrowing money conservatively to enhance the returns into rising markets. And a key factor is how cheaply you borrow. And we took advantage when interest rates were exceptionally low during the pandemic. Remember, interest rates were virtually zero, and the Bank of England was buying massive gilts. And in my view, bond yields were artificially low. And so we actually took out some borrowings over the last 5 years, and we borrowed £30 million going out to 46 at 2.67% and £50 million going out to 2049 at 2.94%. So that's lower than the government can now borrow at, significantly lower. And so those borrowings are now set for 25 years with those annual interest rates. So we can use that money, and provided we can beat those interest rates and our income yield alone beats it, we will kind of add value to our shareholders through those long-term borrowings. In terms of my investment philosophy, I'm sort of valuation driven. And for me is absolutely vital is the share price valuation. I think that will ultimately drive returns. And I'm obviously starting with dividend yields, but looking at a whole range of values. But I want to be in companies that can both grow their dividends and their profits in the long run. They need to be investing enough. So I want to avoid the high yield value traps. And I'm also, the other part of the investment style is it's quite conservative. We like to be in companies with good cash generation. They're best able to pay dividends and invest enough for the future, and strong balance sheets. It's very important in a downturn to be in companies with strong balance sheets. It's leveraged companies tend to get into trouble. So to give you an example of a stock that's really worked for me, in fact, it's the biggest holding in the fund, is BAE Systems, which is it's kind of our national defence contractor, but actually its biggest market is the US, 40% of its business in the US, and it's the 5th biggest defence contractor to the United States government, which is a remarkable achievement for a British company. It's also got a long-standing business supplying in Saudi Arabia, but the real growth is coming from other parts of the world. And this, I felt quite sorry for the management of this company sort of 4 years ago. So they were doing a great job, and it was full of lots of amazing technology. And yet the share price was really doing nothing, kind of going sideways. And then, of course, was the start of the Ukraine war. And, unfortunately, it is a new era. The Cold War peace dividend is over. And, we are in an era where countries have got to rearm. And we're, obviously the US already spends a lot of money in defence, but the real growth for BAE is coming in other countries like in Eastern Europe, where they're selling armoured vehicles and artillery, and they've got a very important relationship with the Japanese government, and also in Australia as well. So, there's terrific growth potential and a huge order book for BAE Systems, and the value has really emerged. In terms of the overall performance of the fund, that chart shows you the very long-term performance since I became manager in 1991, and we are, as you can see, comfortably ahead of our benchmark, which is the main index for the UK market, the FTSE All-Share. We tend to enjoy our best relative performance in difficult markets because of our conservative portfolio. So we had a good year in 2022, for example, when markets were quite difficult with rising bond yields and the Ukraine war. Our current position to the end of April is we're ahead of our benchmark over 3, 5 and 10 years, and only marginally less than 1% behind over 1 year. And that's just a slide that the compliance was very keen we show, which just shows you discrete performance for each year. Now, in terms of the revenue, I talked about the revenue reserves earlier, and this just shows you the picture over the last 5 years. You go back to 2019, we're June year end, by the way. You can see in that year we paid out 94%, so we put about 6% back into our revenue reserve. Then the pandemic hit. I've never, in my whole career, there's never been more dividend cuts. It was unbelievable. And so we had to pay out 21% from the reserves, the most we've ever paid out. The next year, a bit of recovery, we paid out 11%. And then by 2022, we were once again covering our dividend, putting money back into reserves. And for this year, we've indicated a dividend growth of 2.5%, which we've declared our third dividend. And our fourth dividend, the indication is it will add up to 2.5% increase. So inflation today has been announced at 2.3. So we'll be marginally ahead of inflation. Over 10 years, we're comfortably ahead of inflation. And the aim is to sort of beat inflation through the economic cycle. And this just gives you a picture of the dividend going right back to 1966. But at this, the chart, the pie chart shows you just the different sectors where the dividends come from. And you can see it goes back to not having your eggs in one basket. There's a good spread. So if one sector hits difficulties, we're not going to be too beholden to that one. But I'll talk a bit more about how the portfolio is positioned in a moment. So we will now come on to the portfolio itself. So I'll talk first about the UK market. And this chart is slightly grim reading. So over 10 years, the UK has underperformed. The top line is the world index, excluding the UK, and the bottom line is the UK FTSE All-Share. I think the main reason for this is, which the previous speaker mentioned, is really the big US technology stocks have dominated markets. I mean, they are amazing companies and deservedly perform very well. They're on quite high valuations, in my opinion, as well. But they have driven, we don't really have the equivalent in the UK market. We got one or two stocks on those themes, but nothing like the giant companies they've got. But there's also another factor at play, which is I think that UK pension funds and insurance companies have moved away from UK equities. They've moved very heavily into fixed interest because they've taken a very risk-averse, cautious approach, and they just want to kind of match their liabilities. And where they're in equities, they've gone very global. And so as a result, they've been sort of, their UK equity ownership is way lower than it was at the beginning of my career. I mean, it's extremely low. And as a result, the UK is really quite cheap. And, you know, there are various ways you can measure it, but we think it's almost 20% cheap if you compare on a like-for-like basis, strip out the technology factor, but just compare oil companies. I mean, BP and Shell are probably on a 35% discount to Exxon and Chevron, for example, in America, and so on and so forth. And I think the demonstration of its value is just the sheer number of takeovers you're getting across the UK market. And we in City of London have benefited a lot. We've had Wincanton, which has went out at a very good price. We've got Anglo-American, where the bid from BHP may actually not, we're going to find out today whether they're going to go forward with it. We also had a little company called XPP, which was bid for yesterday. We had something called Roundhill Music earlier in the year, which is a music royalties fund. We've had DS Smith, which is being bought for by international paper. And so and these are really foreign companies buying British companies because our valuations are so much cheaper. And I think it's sad in a way, but I think it is an opportunity for people in terms of investing in the UK market. And in terms of valuation, I've got two charts here. The first one is the price-earnings ratio, which measures the share price to the sort of profit per share or earnings per share. And the fact that's kind of below the very long-term average means the market's cheap. And the second one shows dividend yields over 10 years compared with fixed interest yields. And here, of course, fixed interest yields are now caught up with equity yields, having been way lower. I mean, I would argue for a period. I mean, earlier in my career, it was normal for equities to yield less than fixed interest because dividends grow over time. So I still think the yield on the market is competitive, given the kind of low to mid-single-digit dividend growth we're seeing overall across the market. Just to talk a bit about the structure of the portfolio, and we are predominantly in large cap stocks. We're mainly in FTSE 100 stocks, which are kind of global business, and I'll show you a bit about the underlying sales in a moment. We have less in the kind of medium and smaller cap part of the market. We have some overseas listed shares, but we've reduced that a bit. We were 17%. We're allowed to go up to 20% overseas listed, now down to 12%. And I've been switching out some of the overseas listed in favour of the cheaper UK shares over the last year or two. In terms of our sector weights, the biggest single weight is financials. And I've actually moved earlier this year overweight in the banking sector, first time in over 20 years. And the UK banks are in a very good position at the moment. They are benefiting from the current level of interest rates. And they've got much stronger capital balances. And actually, we're beginning to, and they're also very cheaply valued. And we've seen some very good share price moves from NatWest and Barclays are up 50% since February, for example. And we've got Barclays, NatWest, Lloyds, and also HSBC, which is our biggest holding in the banking sector. We've also got quite big holdings in insurance, where Munich Re benefit from rising insurance rates. Beazley, which is the Lloyds of London insurer, has also done very well for us. And in life insurance, we bought a new holding in Aviva this year. So financials is kind of our biggest bet, followed by consumer staples. These are the kind of global makers of everyday products, which tend to be very consistent dividend payers over time and form a good core of an income portfolio. Industrials, with some great British companies, and BAE is our biggest industrial, but we've got plenty of kind of more medium-sized or kind of lower end of the FTSE type companies like IMI or Smiths Industries, which are very high-quality companies. Energy, we are slightly underweight against the index, but we've got decent holdings in Shell and BP. I haven't quite forgiven them for the dividend cuts in 2020, but we've also got Total, the French oil company, which didn't cut its dividend. And finally, healthcare, where AstraZeneca is our biggest holding. We are slightly underweight AstraZeneca, even though it's a top 10 holding. It's quite difficult as a very low yielder to get a full weighting in it. But we have got, we've done very well in Merck, the US pharmaceutical giant. We've also got some GSK where we've been adding to. We think the story's improving there. So this chart just drills down to the underlying exposure of the sales or revenues of the companies we invest in. And I think what's interesting is you can see that only 35% of the underlying sales come from the UK. So basically, the underlying sales of the companies we invest in is really pretty global, and that reflects the UK stock market. So I would argue that by buying through this type of vehicle, UK listed shares, you're gaining global exposure, but at a UK stock market discount. I mean, within our 35% UK, we've got banks, for example, which I mentioned. We've also got some positions in building materials and house builders, which have been suffering in the last year or two, but we think have got very strong recovery potential. I'm certain we're going to need to build more houses in the UK. So this just looks at the top 10 holdings, and I just wanted to highlight some of the lower yielding shares in this, because although we have a yield bias in our portfolio, we've got some very good growth stocks as well, and Relics is a major business information supplier. It's a huge business providing business information analytics for risk and insurance companies. It's the second biggest provider of legal information in the United States for a company called LexisNexis. It also does some business exhibitions as well, and also is the biggest publisher of scientific journals globally. And this is an incredibly high quality company. It's 90% of its business is digital, and it's also one of the, it actually does use artificial intelligence already in some of its operations. So, is a very likely beneficiary of that trend. So that's a good example. Another one is 3i Group, which is actually an investor in private companies, and it's had one spectacular investment, which is in Action, which is a discount retailer in continental Europe, and that's performed extremely well. And 3i Group's been a very, very good share for us. We also, of course, do own tobacco shares. We couldn't own those low yielders if we didn't have British American Tobacco, which yields 9% with a free cash flow yield of double digit, and converting about 100% of its profits into cash. So those, they're out. Obviously, a lot of funds wouldn't want to hold them, but by having those kind of very high yields with BAT and Imperial Brands, the other tobacco company, which is in our next 10, down, at number 14, that helps to sort of pay for the kind of lower yielding growth stocks in the mix. You can see we've also got in our top 20, we've got Rio Tinto, which is our biggest mining stock, Diageo, which is the world's largest alcoholic beverage company, and some interesting financials like Phoenix Group and M&G, which have very attractive dividend yields. So to finish off, I'll just reiterate, I think, the three great strengths of City of London. It's 57 years of annual dividend growth. It's achieved for a consistent core of quality companies, but also undoubtedly there are periods when dividend cuts hit the market. It's the investment trust structure using those revenue reserves that enables us to keep on growing the dividend. Secondly, we have very competitive charges, and they're coming down further in the current financial year. And thirdly, a long-term outperformance of the FTSE All-Share Index in the UK market achieved through a conservative investment style. Thank you very much.